Afternoon, everybody. If you've joined us already, we're just going to wait a couple of minutes for some more attendees to join the webinar. And then we'll go through some introductions, some housekeeping, just to get everything going. Okay, so we've got quite a few attendees already. So welcome to today's webinar on Energy Market Trends 2025, Managing Energy Procurement, Market Risks and Costs from Optimised. For those that aren't familiar with Optimised, we're a national energy and sustainability consultancy with technology-led solutions spanning net zero and compliance, utility management, building optimization, and we're very proud to be a certified B Corp business. We have a strong ESG ethos in everything that we do. Your hosts today are David Schofield, Head of Trading and Risk Management, Pete Hoyle, Senior Risk Manager, and myself, Hannah Johnson, Key Account Manager. And together we've got a combined 47 years experience in the energy industry. We're going to be looking today at the UK market trends, key influences for 2025 going forwards, but a little bit of housekeeping before we begin. So if you have any questions during the webinar, please use the Q&A function at the bottom of the screen. We're going to answer as many questions as we can at the end, depending on how much time we have left. But also, if there are any questions that you need further clarification on or that we weren't able to answer, then please don't hesitate to get in contact with us after the recording, which will be distributed as well. So you can look back on it. If you come up with any new questions after that point, then, please get in touch. Okay, so I'm going to hand over to Dave and Pete now, and they're going to go through the content with you.
Thanks for that, Hannah. So just to get kicked off, I think what we're going to touch on is just a bit of a long-term historic price review. Now, this should be familiar to a lot of you, but for those of you that aren't familiar with how prices have moved over the past few years, we're just going to quickly touch on sort of the pre-COVID state of the market, the post-COVID state of the market, and that kind of interim bit where we had quite a lot of volatility as well. Mainly this is to get people up to speed. A lot of the sort of factors that we'll talk about in this section are still relevant. There's still factors that we still see in the current market. So it's just getting used to kind of what's been driving the market and how the market characteristics have changed over the past few years in particular. I think if we just start by looking at the sort of pre-COVID period, so the pre-2020, and whilst at the time it appeared that we had quite a lot of volatility in the market, prices were moving quite consistently. When you look back historically now with retrospect, you can see that the period pre-2020 was actually relatively flat. There wasn't a lot of movement day to day. You tended to get a bit of a cyclical cycle as well, where your winter prices would tend to be higher, your summer prices tend to be lower. It wasn't a be all and end all kind of rule, but it was a general sort of trend that you would notice. Just for reference as well, what we're looking at here is the monthly continuous prices for gas and for power. That's just the front month on a continuous basis. And I think it's worth reiterating as well, markets react very much in terms of your typical economic trends, so a balance of supply and demand. When your supply exceeds your demand, your price will drop. And when your demand exceeds your supply, then your price will rise. So it's worth just bearing that in mind throughout all of this. Now, if we just start with a few of the key events over this period, just to kind of set the scene a little bit, and we'll start with sort of 2018, Q1, you had the beast from the east. Now, at the time, that was a severe drop in temperatures, increased demand quite sharply across Europe, and as such, we saw prices spike. Now, they were spikes at the time. They weren't that large when you look in comparison to what we've seen since, but it kind of sets the scene for the kind of levels of sort of market fundamentals that were driving markets sort of back in the day. As we move forward from there, the first big impact that we saw driving market prices was in 2020 when we had the COVID lockdowns. That really reduced industrial demand, domestic demand across the board, across Europe and in the UK, or in fact globally, to be quite honest. And as such, you had a real excess of supply, and that demand dropped quite significantly. As such, you can see prices through this time dropped to some of the lowest levels that we've seen historically as well. Now, obviously, at the time, you look back now and say prices were really good. Why didn't people just lock out for a long period of time? There was a lot of uncertainty at the time whether demand would increase, whether people would start consuming as they have done previously or not. So there's still a lot of question up in the air. So that was through sort of 2020. As you move forward into 2021, and particularly the back end of 2021, this is when we really started to see the price rises on an exponential level. And we really started the increase in that volatility level that we were seeing within the markets. Now, this kind of happened predominantly through the first part of winter 2021, so namely in Q4 21, where we had a real reduction in supply of gas from Russia. Russian gas flows were starting to reduce, and as such, prices were starting to rise off the back of that. That pretty much takes us right up until February 2022, when obviously the Russian invasion of Ukraine occurred. And as such, there was a lot of turmoil that sort of fed into the markets. Prices spiked quite significantly. And as such, we then saw a lot of knock-on impacts that were then going to drive markets over the subsequent few years. So pre-invasion of Russia into Ukraine, we were sourcing, and I say we as in Europe, we were sourcing about sort of 50% of our gas directly from Russia. That was a nice stable flow of gas that was coming into Europe, and it meant that we had a lot of price stability. As soon as Russia invaded Ukraine, everybody was trying to embargo Russian gas. We were trying to move away from that. So as such, we had to replace that 50% with other means. And the quickest way to do that was to sort of revert to the LNG market. And we started sourcing a lot more of our gas from LNG and a lot less from Russia. Now, the real impact that that brought into the market, particularly with regards to the volatility, is instead of having one stable flow of gas from one source, instead we were going into a market that was sort of inherent of global competition. So your two major importers, Europe at the time and Northeast Asia. Northeast Asia was slightly greater. Both of those would turn to the LNG market to sort of source additional supply of gas. When you get periods where it's either cold in both nations, it's extremely hot in both nations, or there's just a ramp up in demand, both of the two markets will turn to the LNG market, and as such, you'll get price competition and therefore volatility off the back of that. So that was where it really kind of started. We saw some of that through July 2021. You can see there when we had those heat waves, both nations sort of turned to the market and we had a lot of price competition off the back of that. The next point that we just touch on here, which is the sort of subsequent ramp up that you can see in price, was throughout the summer of 2022. A lot of that off Nord Stream 1, which was the major pipeline from Russia into Europe, and the concerns about that going offline. So flows were reducing through that pipeline, still causing upside effects in market prices. And the risk was that Nord Stream 1 was going to go offline completely. Funnily enough, when you saw Nord Stream 1 go offline, the expectation was markets would spiral out of control even further than they already had done. The reason being is that was the kind of worst case scenario. What actually happened is we saw that risk being built in throughout the market, throughout the summer period. And when Nord Stream 1 went offline, markets actually turned and started dropping off the back of that because all the risk that had been built in prior, when it got to the point of materialization and Nord Stream 1 going offline, we still had a stable supply of gas. And as such, all that risk that had been built into the market then started eroding out of the market. Moving forward from there, and I just want to touch on two seasons, so winter 22 and winter 23, which operated very sort of adversely to a lot of previous winters. Again, winters historically were very typically more bullish. They tended to be as you get into the colder parts of the winter, demand would increase. If you had any unexpected outages, etc., your supply would decrease, and as such, you would see prices increase. Winter 22 and winter 2023 kind of bucked the trend a little bit. Both of those were extremely bearish, particularly winter 23 that you can see at the start of this graph here, mainly off the back of a pretty mild winter throughout, and then EU gas storage levels sitting at some of the highest levels that they've been over the previous few years. So when you've got an ample supply of gas from your LNG, an ample storage of gas across Europe, and relatively reduced demand because of the warm temperatures, you just end up with a very bearish trajectory within markets, as you can see at the very start of the graph there. And then finally, October 2023 was the start of the conflict between Israel and Hamas. And this is now the second state of geopolitical tensions that we're getting globally. Obviously, you've got Russia, Ukraine still ongoing, and you've got everything in the Middle East as well. But the knock-on effects from that introduced or reintroduced more volatility into the markets. And what we've tended to see is when the situation worsens, when those geopolitical tensions heighten, you tend to get very bullish effect in markets, market prices increasing. When things go relatively well, you don't tend to get as much or the same scale of bearishness within the markets. The markets just tend to settle off a little bit. Okay, so that's pretty much the overall sort of catch up on what's been happening over the past few years. It gives you a slight introduction as to the kind of events that drive market prices. The only thing that I want to draw as a last point on this is you can see that final trajectory there from pretty much the end of Q1 2024 through to date. The underlying trend there has been somewhat bullish. There's been a lot of volatility month to month, but the underlying trend remains somewhat bullish. So I'm going to hand over to Pete now. He's just going to run through the winter 2024 season and some of the key factors that drove the market through that period.
Cheers, Dave. Afternoon, all. Yeah, I think as Dave has said there, really, we have seen the overall trend and some of the factors that have fed into the start of winter 24. Um, we have seen an overall bullish trend, but that's not to say it's not been without volatility. There's been a number of factors that have contributed to this, whether that be weather, geopolitical events. We have concerns over demand, storage, also how LNG and the impacts of that, and all of those have really fed into prices throughout the winter period, and really have led to this period of volatility that we have seen over the past 6 months. I mean, as Dave has just shown on the previous slide, it is probably longer. It does feed in for a longer period, but just for the period that we are focused on, and particularly winter 24, we have seen strong volatility throughout this period. So first up, we here one of the key drivers, and it will be a key driver going forward as well. Not to spoil any of the future slides, but really we're looking at EU European gas storage. Now, when we're going back again and feeding from 2022, the EU did bring in a directive that all their members had to have storage facilities at least 90% full, or 90% of their capacity. Now, for 2023, 2022, they were comfortably at that target. And again, coinciding with the warmer weather, that helped to alleviate some of the pressure that was around the market. This year, again, throughout 2024, the storage levels, generally speaking, were quite comfortable and really healthy. However, what we did see is there's a combination of factors. We saw some cooler weather earlier. Also, a couple of supply issues, which in and of itself was not a major concern. But what that did mean is that we started to see withdrawals from storage earlier than we had seen in the previous two winter periods. Then in addition to that, then we saw the cold weather that hit throughout December, January, going well into February, and that meant that these withdrawals continued at a quicker rate than they had done in any year since 2018. Again, if you just look at the sort of the trajectory of the live 2024, late 2024. And 2025, they are quite steep compared to the relatively shallow lines that we'd seen for the previous 2 years. All this means now really is what a lot and it's contributed to the volatility, particularly around certainty of supply, and it did have an impact further afield as well. We were seeing these withdrawals from storage and the potential impact this may have longer term. Do we have what is certainty of supply? Longer term, are gas storage levels going to be lower than they have been? What does this outlook look like essentially? The fact that storage levels are lower than they have been in 2023 and in 2022 has just added to that risk, alongside the colder weather, that if we do have any additional supply concerns, then we may see to a tightening of those supply demand outlooks that there's again, excuse me, as Dave touched on it earlier. Another key driver, again, as David said, is touched on before, is LNG flows into Europe. Now, flows throughout 2022, 2023, and 2024 have been robust. What we did see is a bit of a drop off in Q3 24, partly, and that drop off coincided with a few supply issues globally and a little bit of an increase in Asian demand. What we saw though into Q4 is cargoes ramped up. So again, it contributing to that volatility as the supply outlook remained relatively healthy despite the other concerns that we did meet. We saw robust flows of LNG into UK and Europe, partly supported by healthy supply and also by relatively weak Asian demand. And we saw the European gas price elevated, which also really was off-putting for Asia as it had to compete with that price for cargoes that ordinarily would be diverted to that region. Again, another important driver as we go back to, if we go take a step back to the part earlier that Dave was touching on, in terms of Russian flows, as those Russian flows into Europe have reduced, we have the increase in Norwegian gas flows and LNG have helped to offset those reduced Russian gas flows. Norwegian flows now account for around about 30% of EU gas supply into Europe. And although we did see flows throughout winter 24 have been stable, there has been intermittent periods of maintenance. So again, it's just contributed to that volatility. We've also had with the colder weather and the impact on storage. So a lot of that risk that we've mentioned before has just fed into the volatility that we've seen throughout winter 2024. We did see an uptick in flows we have seen an uptick in flows from 2021, 2022, again, and that has contributed to the overall percentage makeup of Norwegian flows from the European supply mix. And again, one of the other points again is geopolitical tensions. So we've spoken about previously the impacts of Russia-Ukraine and the reduced Russian flows and the potential risk there. There continues to be underlying risk around the conflict with Russia and Ukraine and potential escalation of that conflict into Eastern Europe and potentially further afield. Another point as well that's key around that is the impact that would have on energy infrastructure within Europe. Potentially, we have seen Russia particularly targeting Ukrainian energy infrastructure with drone strikes, also undersea cables. Dave mentioned earlier about Nord Stream 1, for example, Nord Stream 2 pipelines. So the undersea cable region in the Baltic Sea. Again, these energy infrastructure across Europe is a relatively soft target, so that risk continue to be in place. Whilst we saw tensions continue to escalate throughout this period. The other point around the Middle East, again, is in and of itself, there's not really a significant impact on supply from the region from when we're talking about Israel, Palestine, Hamas, etc. And the impact really is to do with Qatari LNG due to the proximity of Qatar to Iran. Again, throughout 2024, we did see escalation of conflict between Iran and Israel, potentially with the US getting involved. There was concerns what that would look like, and we did see further escalations, potentially leading to blockades off Iran and the subsequent impact that would have in terms of Qatari LNG and the shipping of that LNG into Europe. Potentially, we would see a tightening of supply should that occur. Once again, whilst there was no significant impact in terms of supply coming into Europe, it was the risk or potential risk of that impact on supply, which just fed into the volatile nature that we've seen for prices throughout this period. And just lastly, I think I've touched on this a few times already, but we have seen colder than normal weather throughout winter, generally speaking. The early part of Q4 continued to be above or in line with seasonal norms, and it just helped to curb some demand as we experienced relatively mild temperatures. However, once we got into November, towards December, we did start to see those temperatures drop in line with some of the factors that I've mentioned previously. This just contributed again to the volatile nature. We saw an increase in demand. There was concerns over storage. There's those geopolitical tensions that were ongoing, potentially impacting supply. As well as that did feed into the LNG risk as well, what I've mentioned with Qatar. So all of this was a contributory factor. As this cold weather continued throughout Q1 2025, and we obviously saw an increase in demand and the continuation of that demand, the demand increases, sorry, it just added further pressure, and we saw again stronger withdrawals from storage and all of the risks that we spoke about earlier. Just it was a continuation of those risks, and they were just exacerbated, all of which have fed into the volatile nature of the market that we have seen throughout this winter period.
In terms of looking forward, I think Pete's touched on most of the key points there. What's been driving the market over the past kind of 6 to 9 months, even longer, and a few of those points we touched on right at the start of the presentation. A lot of those are still going to be key drivers going forward, and in fact, the main fundamentals that will be driving the market. There is another layer to this, which we've not really got into, more around the technical side of things, which is the sort of technical buy-in. That's your price analysis, and then you get buy and sell signals off the back of that, basically, and that sort of instigates trader behavior, I suppose. When you get a sell signal, several buyers or several traders will start selling out into the market. That's then a perceived reduction in demand, and as such, markets will drive. But if we focus just purely on the fundamental aspect, we can break that down into 2 topics. So your bullish factors and your bearish factors, symbolized by each of the 2 icons on this page here. I think the best way to summarize how summer 2025 will outturn, and again, there's an array of fundamentals that could feed into this. We've just cherry picked some of the main ones here for you to be discussed, and this is all subject to change at any point. But I think what we're trying to expect is the level of volatility will still stay increased. If we look at volatility kind of pre-2020 to now, from a percentage perspective, it's relatively similar, or pre-Russian invasion, it's relatively similar, but from an absolute perspective, i.e. the price movement itself, it's far greater, because we're talking much greater figures from the outset anyway. But that level of volatility is expected to remain relatively high. Any upside risk within the market is far outweighing any downside potential within the market. Basically meaning that if things escalate geopolitically, if things worsen from a EU gas storage perspective, or whether we get some extreme heat waves over the summer, then we're expecting to see markets increase at quite a rapid rate. That being said, if things go well, if sort of geopolitical tensions de-escalate, then what you'd expect to see is probably not as much downside as the converse if the market increases. That being said, if a lot of the bullish factors that sort of risk is being built into the market for, if they fail to materialize, then what you could end up seeing is the market being slightly more bearish than initially anticipated. So we'll just dive into a couple of those factors on here. So EU gas storage replenishment, Pete touched on it before. We've always, well, for the past few years, we'd have targets of 90% by November. Because we've been withdrawing from storage at a much greater rate over this winter than previous years, we're starting off this year at a much lower state of play in terms of those gas storage levels. That means there's going to be a greater focus on replenishment of those gas storage levels over the summer period. It increases demand, puts a little bit more pressure on. And that's going to be one of the main bullish drivers over this period. Now, they're looking at that 90% target for November. It might be that that gets revised in sort of future months, but at the minute that still remains, whilst they've sort of relaxed a couple of the interim targets, I suppose. That being said, it is still one of the key drivers going into this summer period. Next up is in weather, and this is not just weather across Europe, this is weather globally, particularly in Northeast Asia and in Europe. We've seen it in previous years when you get extreme heat waves, and if they coincide in particular in the 2 regions, then you'll get an increased demand in both regions. Both will turn to the LNG market. As such, you'll end up with a competition, which will lead to higher prices. That being said, if temperatures are somewhat moderate, if they're relatively mild and they're not too excessive, then the impact will be a lot less pronounced. The other one is just geopolitical tensions. Now, this is obviously the one that is probably the most volatile factor on there. You've got two areas where there's a lot of geopolitical tension at the minute. We've touched on them quite a lot through this presentation. Russia, Ukraine, that's sort of the one closest to home, I suppose. And then you've got everything going on in the Middle East as well. It's not necessarily what is occurring right now, it's the what if scenarios. If things escalate, if other nations get involved, if supply routes get impacted off the back of these geopolitical tensions, then it's the risk factor of those and how that could impact the market. What we're expecting to see, as I mentioned earlier, is that if you get any escalations in either of the two regions, things start sort of outturning not as we'd hoped for, then you're going to see a knee-jerk reaction in the market. You're going to see the market spike. And we've seen that several times over the winter period where news stories have leaked, and as such, the market's reacted in a very sort of bullish fashion. When we start looking at a couple of the bearish influences over the next few months, the first one is LNG supply. So that could act as a bearish factor if supply remains strong. We've got relatively strong supply at the minute. It has been for sort of a number of months. And if that continues to be the case, or if we see demand easing in Northeast Asia or in Europe, then we're going to get more of an excess of supply. And as such, that'll ease prices a little bit and dampen a bit of that volatility over the summer period. And then lastly is around peace deals. It's specified as a Ukraine peace deal here, but I suppose peace deals in both regions. If we get peace deals sort of agreed, that should de-escalate a lot of those geopolitical tensions. It might start increasing the flow of gas from Russia. Not that I think Europe will return to having just, or not just, but a majority reliance on Russian gas, but it will just increase the flows of gas into Europe. And as such, we might just see a little bit of easing in market prices off the back of that. So I'm just going to hand back over to Pete, who's just going to go through a couple of the, oh, in fact, before we do, I've got one more slide. I do apologize. And this is more of just a market price look. And if you look at everything to the left-hand side of the graph, that's how the markets have developed to date. Again, that monthly continuous price. If you look at the dotted lines going forward, these are the forward curve as of when this was produced. Now, this is not a forecast for how prices are going to outturn. This is a snapshot of those forward periods if they were to be traded at this point in time. And I think one of the key things to sort of draw from this is the current backwardated state that the markets are in. It's not as heavily pronounced as it has been in previous years, but there is still a little bit of backwardation in that market. What do I mean by backwardation? It means that with every sort of subsequent year, prices are trading at a discount to the previous year. And you can see that by this sort of stepping down year on year. What that means is that when you've got a backwardated market, looking at longer term purchasing is a benefit because you can access those discounted prices at a nearer point in time. You can start reducing your risk well in advance, and you can spread that risk over a longer period. So if you're on a flexible contract, it might be worth making sure that you've got a supply contract out for a sufficient time, typically 3 years, and then you can start building your position over a period of time. If you're on a fixed term contract, it might be worth considering sort of longer term contracts, not just your standard 12 months. You might want to consider 24-month options as well. But it's worth considering that as well. Okay, now I'm going to hand over to Pete, and he's going to go through a couple of the key risk factors.
Thanks, Dave. Yeah, as Dave has touched on here, so just looking at some of the key risk factors around for future pricing, really. One of them, again, I think as both of us have touched on this already, is storage levels. Now, this will be a key driver for European gas and power prices for the foreseeable future, particularly as there is that requirement to replenish these stocks to that target. Now, in addition to this being a driver because of that target, it's also to provide us with the certainty of supply should we have a really cold winter. There has been a significant amount of risk in the market. Do we have sufficient supply to meet demand if we have a really cold winter? Since we have moved away from that stable, since Europe, I should say, has moved away from that stable supply of Russian gas in 2022, and that is again part of the reason why the EU did bring in the directive around storage level targets to ensure that we did have certainty of supply through winter periods. 2022 and 2023, as we've already discussed, were relatively mild, so a lot of that risk was still factored in. This year, as we had a colder winter, albeit it was relatively late that we experienced those cold spells. If that occurs earlier, or for longer, we have that cold spell lasts for longer, then again, that's just going to exacerbate that risk. Also, feeding into storage is the European storage targets that we've touched on as well. Currently, it stands that all members must have their facilities again, as I've said, at 90% full by the 1st of November each year. The EU did recently allow that they were looking into amending this so members have flexibility on targets, and particularly as a few members, such as Italy, have lobbied to have this target reduced to alleviate some of the demand for injections throughout the winter period, potentially allowing prices to retrace. They have said this afternoon, though, that the EU committee have said that they will be recommending that they maintain this 90% target until at least 2027. So potentially we will see support for prices throughout the summer period if that is ratified. However, it may alleviate some of the risk for winter if we do have gas storage levels that are at or close to capacity going into the winter period as well. The next point is around Asian demand. Now, we have seen quite a bit of volatility itself in Asian demand over the past few years on the back of COVID. There has been times when it did look like it was going to be resurgent, but generally speaking, it has been quite stifled. The reason why Asian demand is so important is feeding back in again to LNG. If we do start to see any growth in the economy and in demand from Asia, we would expect this to have a subsequent impact on LNG and the region's an increase in the region's demand for LNG. In addition to sort of the three big players, which are Japan, China, and South Korea, we are starting to see more and more emerging markets turn to LNG as an alternate fuel source. So the likes of India, Pakistan, Thailand, Vietnam, Indonesia, etc. They are looking more and more towards LNG and looking to have that infrastructure replace the fuel sources that are already there with LNG. Now, again, if that does occur, depending on the global supply of the fuel, we may start to see an increase in price as well as demand starts to increase from those regions. And then the final point, again, we have touched on this already, is Russian gas. Now, it has been in the news quite a bit recently, just on the back of what's gone on between Zelensky and Trump. But potentially, if we do start to see any sort of peace deal with Russia or an alleviation, relaxation of the sanctions that are in place from Russia, we may start to see an increased output of Russian gas and oil. Now, as it stands at the moment, and again, Dave touched on this earlier, it's unlikely that we will start to see flows from Russia increase to the level pre-2022, just because of the risk and the fact that Europe does not want to be solely reliant on Russian gas flows. However, just because of the nature of the market, if we start to see increased gas flows into the market space, potentially we will see a direct impact of flows into Europe. But if we do start to see increased output from Europe, even if they are not coming directly into Europe, that could alleviate some of the risk in the market just by increasing global supply. Okay, and then longer term, we just have a couple of points here. One is climate, and again, it's been in the news relatively recently. We have seen a couple of key players within this market have a shift away from their net zero and climate change focus, particularly the US and some of the larger gas and oil producers. A greater focus is once again being given to fossil fuels. Now, within that at the moment, from a short-term, medium-term perspective, it's unlikely we'll see any significant impact on the market. Longer term, it may just lead to a reduced innovation on energy and an increased reliance on fossil fuels for a longer period of time, which again potentially could provide support to the market, depending on how that materializes. And the final point linked obviously to that is renewable generation. Within the UK, we have seen, generally speaking, an increase in renewable generation over the past few years, as particularly UK and European countries strive for sustainability using their own resources. We do expect to see in the, again, short to medium term, the continuation of this. If we look so far in 2025, we can see that we're at 37%, and this is without the really the key summer period when we would expect to see an uptick in solar. Again, if we start to see an increase in renewable generation, potentially we could start to see that weigh on prices as well as generation becomes much more sustainable.
Okay, well, thank you very much for that. So we're going to move on to the Q&A session. And we've got a couple of questions that have come in. If you do think of any other questions, while we're talking, please do put them into the chat or the Q&A area, and we'll address as many as we can. We've made really good time in the webinar today, so hopefully we can give you a little bit of time back, but we'll answer a couple of those questions beforehand. And again, if anything does come up or you want to discuss anything in more detail or how it directly affects your accounts, then please do contact us. So a couple of questions, and I'm not sure where Dave or Pete, if who wants to take one of these first, but so the question centres around the impact of the peace deal and what impact that's going to have on the market. So is it going to be an immediate impact, or are we thinking it's going to be more of a long-term impact?
I'll jump in and get that one, I suppose. I think if there is a peace deal agreed, like we were saying earlier, the impact of any bearishness is going to be somewhat limited. I think you might see a little bit of price easing. You might start seeing Russian gas feeding back into the European market, but you wouldn't expect to see prices drop off a cliff. You would see it more short term, I would say, but then that would be sort of prolonged throughout prices over a period of time. But you'd see the immediate effect short term, I think.
And I imagine that most people would they might be thinking that it's going to go back to the way it was pre any kind of tension, like geopolitical tension, but we don't think that's the case, do we?
No, I think we're set up for kind of a new norm, if you will.
Yeah.
It's not going to revert back to sort of pre-COVID levels, I don't think. I think those days have been and gone now. It's very much the case that, like I say, any positive news with regards to a peace deal will be somewhat dampened the effect. That being said, any sort of alternative impact. So if peace deal doesn't get agreed, if things escalate again, the likelihood is you'll see quite a sharp bullish reaction in markets, and that would be quite pronounced.
Okay, so that kind of leads on to the next question quite nicely, really. And that question is, what recommendations do you have in terms of forward purchasing? And I imagine the answer is going to be very different for each business, but over to you, Dave, Pete.
Yeah, I don't mind getting that one as well. It's a very subjective topic, and I think it's going to be sort of a case by case scenario. So I'd really recommend reaching out to your account manager or one of our team if you want to discuss that in a little bit more detail. If you're trying to generalize it, I suppose those that are relatively risk averse, you want to be sort of increasing that hedge level. Like I say, the upside risk is far greater than the downside potential. So whether that's looking at a fixed term contract for a period of time, or whether it's taking a flexible approach, making sure you've got a contract that covers a 3-year span, and looking to just hedge a little bit heavier to sort of eliminate that risk from yourselves, then I will be doing that. Those that have a probably greater appetite for risk, so a little bit less budget certain, more about chasing lowest price. Volatility is often seen as a risk. It's often seen as a bad thing. It's also an opportunity. Having volatility in the market means prices are moving quite large magnitudes, both on the upside and the downside. So you can really take advantage of that volatility, and if you can be quite proactive with your trading, then you can really take advantage and capitalize on that to lower your price. So that would definitely need sort of a more one-on-one conversation to understand the risk appetite and how best to capitalize on that. But
Yeah, definitely. And that's all down to kind of business needs, isn't it? And business appetite for that risk versus reward.
Certainly worth mentioning, though, that if you were to adopt that kind of approach, it brings with it risk.
Yeah.
I think that's a given.
Yeah. Okay, and the final one that we've had through, or that we're going to go through today, is what are the long-term effects of the Baltic states disconnecting from the Russian power? That's quite interesting. I was reading this again in the news this morning and watching the videos. So what do we think the effects of that are going to be?
I'll take that one, Dave. In and of itself, there shouldn't be a significant impact on the market. really a lot of it will tie into what we've said before around risk. So what we've seen with that is there wasn't the Baltic states, they weren't heavily reliant on the Russian grid, but what they did see in times where there was outage or power cuts, they would be supported by the Russian grid. The knock-on effect of that directly would be if they do have that, that's going to come from Europe now, so there will be potentially an increase in demand at that point. But given what we've seen and given how that given the overall supply makeup, we would expect that to be captured within across Europe. So we wouldn't expect it to have a significant impact. The larger impact really feeds again into the risk. If we don't see, just because of the proximity of those states to Russia, if we don't see that peace deal, these states are now heavily reliant on undersea cables from Finland and Sweden, as well as cables from Poland. So if they are, and I think I touched on this earlier, they are relatively soft targets. So if Russia look to damage energy infrastructure, or they'd look to target those undersea cables again, and it does leave them without access to that supply from those regions, potentially we could see an impact at that point. But again, directly speaking, we would expect it to have a negligible impact.
Thanks very much, Pete. Okay, so we've made good time. I think we can give everybody a few minutes back in their day, which I know is always precious. Thanks for joining us on our webinar today. We've touched on some topics that are very direct for your actual businesses yourself. So if you want to have any more in-depth conversations with us, then obviously reach out to your account manager if you're currently working with Optimised, or you can contact us via the Hello Optimised email address on there, and we'll get back to you and we can have those discussions with you. But thank you for joining us today.
Cheers.
Thanks all.